Hello, everybody. So in times of extreme volatility, in times of such a bad market crash, I believe it's good to look at the top of the market, to look at the best companies. The best performing companies are, of course, the Mag 7, the most followed companies, the most liquid, but also the first ones to be sold whenever there is some fear. And you can see that a lot of the gains, sometimes the gains going back as far as 2020, have been erased. You look at Amazon. Amazon, we're at the level of July 2020, as Heisenberg on Twitter reminds us. Some of these stocks are trading so low. In fact, five of them are trading back to the 2021 levels. We've erased the gains in a matter of 4 to 6 weeks. But in my view, we should make no mistake. These companies are the top of the NASDAQ, and the NASDAQ, of course, because the NASDAQ has such a heavy weight in these companies, the NASDAQ has beaten the S&P by a wide margin, in my view. 5% is nothing to sneeze at when you look at things over the longer, and especially after a 10-year period. Don't forget the S&P also has a lot of these companies. So what I want to do today is a deep dive on these Mag 7 companies post-crash. This is the post-crash deep dive. So let me just get started with Apple. So Apple is the world's largest company. I mean, if you forget some foreign companies, perhaps some Chinese banks, you can always argue, or Saudi Aramco. But even if you include those, Apple, as far as I'm concerned, is the world's largest investable company. And the returns of Apple have been 26% versus QQQ 14% over the past 18 years. So that's extremely outstanding to just be able to achieve these returns. Most investors don't achieve these returns, but whoever has held Apple just achieves the return by virtue of holding Apple. Apple right now is definitely the most hated Mag 7. It once was a great stock, but a lot of people don't like it. And I don't like it either, but I don't like it because the revenue growth is sneezy and disappointing. It's making me yawn. Like what? Anyways, it's not good. 5% revenue growth is not good. You're not beating the denominator. This is a company that mostly grows through buybacks, which is another thing that I don't like. I would much rather see a company grow through sales growth than through buybacks. But the point is, they have a very addictive product, and of course, the stock is way down right now because of a tariff fear, because people say, oh, iPhones are going to cost $1,500 in the US. Well, so what is what I want to say. So what if iPhones cost $1,500? People will stop eating if they can get their iPhone. People will just literally stop every other expense to get their iPhone. This is the stickiest, most addictive product. People will cut on anything. If their iPhone breaks, they will rush to buy another one as soon as they lose it. It's the stickiest, most addictive product. And for people who are looking at queues, if you want to have queues as to whether can you sell an iPhone 15 for $1,500, well, look at Europe for queues, right? The salaries are not as high as in the US in Europe, and they pay $1,400 for iPhones. Why do they do that? Because of the VAT. And so the VAT, you can think of it as kind of like a tariff, an internal tariff on companies. If the US saw a rise in the iPhone prices, my guess is that people would buy them just as much because they are addicted. It's funny that we are now refocusing on iPhone, the product, because, of course, if you study Apple, you know that a lot of the sales come from the cut on the App Store, how much cut they get, and all of these antitrust issues of them charging 30%, getting a 30% cut on anything on the Apple App Store. Apple makes a lot of revenue from services. The market seems to entirely be forgetting about that. And is innovation dead? That's the other big debate with Apple. Is the innovation dead? In my view, I am not sure. The Apple Vision Pro, I tried it. I was thoroughly impressed by it. Sure, it wasn't a commercial success. They didn't sell a lot of it, but that's because it's not as essential of a product yet as the iPhone is. But I believe they will be in that race when VR becomes a thing. And I thought Vision Pro was very impressive, even if it was not a commercial success. It's all about the present value of future cash flows. if it's ever successful, they have a shot at the next computing platform. And to the best of my ability, the best of my reading about Apple, it seems like a lot of people who were working on the robotaxi are now working on an Apple bot. Are we going to get an Apple bot someday? Maybe. And so to me, this company is nowhere near dead. They make a boatload of money. They are cash rich. Yes, they put a lot of money in buybacks, and that's unfortunate. I would rather see them invest in the future, invest in their growth. But is it worth the tremendous decline that it's been going through the past few days, in my view? Is the market really being fair? I don't think so. I think the market is entirely overreacting. Moving on to Nvidia. Nvidia is a stock, and I entered that stock on Friday via out of the money leaps. Anyways, Nvidia is officially a no-brainer for me at this point, trading at $94. I had said for the longest time, if it gets under 100, it's a buy for me. That's it. We are there. It's, in my view, out of all of the Max 7, not the QQQ, right? I should have said Max 7 here. Out of all of the Max 7 stocks, this is the cheapest, and this is the most consensus stock out there. You will have a very hard time finding anybody argue against Nvidia right now, and I even see less and less people who see Nvidia as expensive, given their opportunity and the size of their massive opportunity going forward. To me, this stock has the most attractive metrics, and so I hear a lot of folks in the comment section calling their favorite stock cash printing machine. Someone did that the other day, and I looked up the stock, and the stock had like a, I don't know, was it a 9% EBITDA margin or something like that? A stock that has a 64% EBITDA margin is a cash printing machine. In fact, EBITDA margin is a proxy for cash flow. If you want to treat Nvidia like a cash printing machine, I think one can rightfully call it a cash printing machine, because if they are trailing 12 month sales 130 billion, they're going to grow by 60% next 12 months, and you multiply by the cash, that means that next 12 months, in the next year, they should bring in 134 billion in cash, in USD cash. And at a market cap of 2.3 trillion, that means this stock has a 17 times forward multiple for a company growing revenue at 60%. And so that's why this company fares so well in my metric, enterprise value over gross profit or revenue growth of a 0.39. If you were to input Nvidia in the PEG ratio of Peter Lynch, it would also be doing very well. This company has insane growth for Max 7 at 60%. This is a growth that you see exhibited for much smaller companies usually. Also, please note that while Apple's product are going to have tariffs, right, next week, if that's not a negotiation tactic, as the market seems to believe it's not a negotiation tactic. Anyways, if tariffs are actually put in place, may I remind you, there's no tariffs on semis. Semis are excluded from that. Nvidia is not going to be impacted by that, yet the stock dropped 36% since the beginning of the year. This is literally the AI behemoth. This is the company that has a hand in everything AI. They invested in a bunch of data centers, right? They invested in Nebius. They invested in CoreWeave. They have their hand in everything. They're now tackling inference. I know there's a lot of people who love AMD online, saying, oh, AMD is going to be winning at inference. Well, guess what? If you look at GTC, now Nvidia is going all in on inference as well. It's just not an AI training story anymore. To me, this stock has become a no-brainer. And when I look at the past performance, you can see since 2015, it has achieved 67% average annual return versus the NASDAQ at 15%. So this stock for me has become a no-brainer. This is obviously no financial advice, but I am now in this stock. I'm now invested in this stock in the form of options. Anyways, moving on to Amazon. Amazon is a inexpensive stock. It's my third inexpensive stock in this spreadsheet. Amazon, think about Amazon. Amazon is back at July 2020 levels, as if nothing happened for the past nearly 5 years. The company is much bigger, The company is much better now. Don't forget that Amazon is the most loved company out there. Their net promoter score is absolutely insane. When you ask people who use Amazon, would you recommend Amazon to a friend? They overwhelmingly, something like 98% say, yes, I would totally recommend Amazon to a friend. They've become a verb. We don't say buy it online anymore, at least in the West, right? We don't say buy it online anymore. We say buy it on Amazon. Right? We don't say search it online, we say search it on Google. We don't say buy it online, we say buy it on Amazon, right? So anyways, this company is insane. It's got a lot of operating leverage yet to be achieved. They're still investing heavily in their growth, and a lot of people complain, saying, oh, the investment in their growth sometimes may be misplaced, but there's a lot of operating leverage. They're a leader in the cloud computing. They invented cloud computing essentially, but they are still the leader. They're still growing very fast. The only downside for me, in my view, for Amazon is that it doesn't grow. It doesn't grow fast enough because I'm a growth snob and I want to see high growth. And 10% is too mature for me. And of course, I'm not going to blame them for not growing fast enough. The revenue is 637 billion. Like the revenue is a GDP of a medium European country. Is the revenue of this company? The GDP of a medium European country, 637 billion. That's absolutely insane revenue. And so growing that at 10% actually is pretty darn impressive, but nonetheless, I find the growth a little too low for me. It's a sleepy stock, it's a swan stock, it's a savings account type stock. I look at it as a savings account. I don't look at it as a growth stock. Nonetheless, I am the first one to admit that the performance on Amazon has been outstanding. 26% average annual return since 2015 versus the NASDAQ, of course, at 15%. And the stock is down 30%, like the market has sold off indiscriminately. And, I'll just say, the end, I said that in my prior video on that, the end of a de minimis exemption for Amazon is a huge deal. The fact that now Temu is going to have to pay taxes on products it ships straight from China to the US is a big deal because Temu was taking some business from Amazon. Now that business is coming back. If you want to learn about Amazon and how amazing Amazon is as a company, I recommend this book, Bezonomics. It's a book from 2020. And it's in my view, it's absolutely excellent, and it builds on Jim Collins. If you followed Amazon, you know that Jim Collins was influential in creating the flywheel and shaping Amazon. In the early days of Amazon, Bezos was flying Jim Collins to Seattle so that he would train the executives. This is the company that literally invented customer centricity. This is the company that so many other companies have followed in the way they do business. It's all about making the customer happy. They will keep that flywheel going, in my view, but right now it's tough to believe that it hasn't done anything in 5 years. The 2020s are going to be nothing like the 2010s. To me, the 2020s are looking more and more like the 2000s, the kind of a lost decade, the 2000s. Hopefully I'm wrong. I may be wrong. Hopefully the 2020s are not like the 2000s, a lost decade. I hope I'm wrong on this. But anyways, Google. Let's move on to Google. So Google, yet again, an outstanding company. It's been battered, right? The stock is down 30% since February 4, which I guess is normal because every single Mac 7 has been battered like that. But still, it's just as unfair to Google as it is to any of these other firms. And yes, for Google, I know the narrative, right? The narrative is large language models are going to kill Google. What's hilarious, folks, is that it's Google who invented the transformer architecture, right? The transformers, what's behind those GPTs, those LLMs out there, they were invented by Google. Google is the leading company in AI, or at least it was across the 2010s. They invented it. Sure, OpenAI implemented it and forced Google's hand, but they did. They have 9 apps with more than 1 billion users. This is insane network effects. We're on YouTube right now. I could make a case that YouTube is likely worth 1/3 of Google, because YouTube should probably be valued at a higher price than Netflix, and Netflix is a super expensive company. I could make easily the case that YouTube is worth 1/3 of Google. This is also an important point. Even if LLMs take a lot of business from Google, researching information about, I don't know, how to put together a presentation or how to write a cover letter, researching that information is not nearly as profitable as, for example, this type of search, which is like, oh, cost of a swimming pool in my hometown. Insert your hometown and type cost of a swimming pool, right? How much is that contractor paying for the click? Probably $30, maybe more than $30. Google makes a lot of money through localized searches. That's one of the areas where they make a tremendous amount of money. And that, right there, is not, in my view, going to be disrupted by LLM just yet. So I'm fully aware of people arguing, well, what if it's the LLM who decides for you and like shops for you? Well, in that case, maybe, but we're not there yet. We're not just there yet. And when you ask people who are not deeply connected to this, and you ask, oh, do you use AI? They're like, oh, yeah, I use AI. And then you're like, oh, okay, what AI do you use? Do you use Llama 3? Do you use Quark? They're like, oh, no, I just use it on Google. Oh, no, it's just whatever comes up on Google. No, Google has AI. Like, most people don't make the distinction. We make the distinction because we are heavily connected to this. But most people don't. So anyways, it doesn't matter. Even if they lose search, look at this. They own 7.5% of SpaceX. How many, to speak like the youngsters, how many trills do you think SpaceX will be worth in the 2030s, right? They own 7.5%. They are the second largest owner in SpaceX. This is my big reason for owning Google. I own Google. And by the way, you may think SpaceX is going to be zero because you don't like anything Musk does. And I know there's a lot of people like that who do not like anything Musk does. Well, then Google is also the stock for you because they own Waymo. Waymo is the only competing alternative loved by TradFi. You know, of course, Tesla believers, and myself included, I don't think Waymo is much competition for Tesla. But if you believe that Tesla is not going to make it, you probably believe that Waymo is a good competing alternative. And guess what? Tesla's robotaxi are announced in Austin. Waymo is coming to Austin. Waymo is going to be the competitor to Tesla's robotaxi. You have that included. How much is Waymo worth? I remember a few years back reading analysis from very serious people saying Waymo could be valued as much as $500 billion. Oh, and by the way, they own Android. They own the direct competitor to Apple. They own Android. Right? Google is not going anywhere, folks, and I have not even discussed their cloud initiative. They are a major player in cloud computing via GCP. And if you add all this up, you see the stock is down 30%. But over the long run, let's make no mistake, over the long run, it has returned almost 24% a year, average annual return compounded. So I do love Google very much. Moving on to another stock, Meta. So Meta is the second everything. It's the second fastest, second cheapest, and second highest rule of 40 in my spreadsheet. So that's a lot of seconds for Meta. Meta kind of reminds me of Texas. Anyways, turns out that Meta, viral videos, right? Viral TikTok videos, turns out they did not kill Meta, right? Instagram just copied, and the videos now, these viral videos, you find them everywhere on every single social media. TikTok oftentimes is the social media where they thrive the most because TikTok is still, I believe, a better recommender system. Although I don't use TikTok, so I can't really speak to it as a user. But nonetheless, you know, Meta survived. You remember a few years back, the narrative, this stock was trading under $100. Imagine that. Anyways. That's not the point. I mean, Instagram is obviously huge. We'll get to Instagram in a second. WhatsApp. Let's talk about a side business, quote unquote, a side business for Meta. WhatsApp is, you know, kind of a WeChat of the West, if that makes any sense, right? How many people do deals on WhatsApp, buy stuff on WhatsApp, and it's literally disrupted texting. In most countries, WhatsApp had disrupted texting. Think about that. It disrupted an open source, small messaging service, SMS technology, entirely disrupted it. So that's absolutely outstanding to me. Now, did you see the news on Llama 4 this weekend? Apparently, Llama 4 is quite outstanding. I've tried it. It seems very promising. I remember switching from Llama 3 to Grok. Am I going to switch to Llama back? Am I going to use Meta AI again and switch to Llama 4 now? Because Llama 4 is rating much more in the benchmark. The announcement that they did this weekend was very impressive. They released a model that is better than DeepSeek, by the way. And so these fears that DeepSeek put in the market a few weeks back, well, are Meta going to trigger those tomorrow? We'll see. But Meta did something very impressive. What I like about Meta is the second fastest growing, like I said. And they have, of course, an insanely addictive product. There's billions of people that are hooked on Instagram. Many, social analysts, psychology writers, I think correctly analyzed Instagram as an addiction. Instagram is addictive. It's more addictive than cigarettes. It's probably more addictive than a lot of video games. It's a very, very addictive product. And ask yourself how many Gen Z are on Instagram and are addicted to Instagram. And again, most of my viewers are in the finance space, so the social media for finance is X. But if you go into some spaces, I think about like women's fashion or a lot of interest that are visual, a lot of visual people. Instagram is their thing. They're entirely hooked to it. They can't live without it. It's just like cigarettes. This is almost a recession-proof product because of that. And lastly, they have optionality. Meta has optionality because of their investment in the next-gen computing platform, which is likely going to be some sort of VR, some sort of glasses, and they're investing heavily in that product via their Oculus Quest, right? I don't think we call it Oculus. We call it just Quest now. But the Quest division, is the commercially successful version of the Apple Vision Pro. Apple Vision Pro, of course, the lack of success was because of the pricing, in my view, not the lack of a product quality, but the point is you have that optionality in the next-gen computing platform. I can only think of two companies that have optionality in the next-gen computing platform. It's Meta and Apple. I don't think the other ones have much to do in the next-gen computing platform. Anyways, this stock is down 31%, but if you look over the long run, the stock is at 22% average annual return for the past, let's call it 13 years. So nicely outperformed the NASDAQ by a wide margin. And this is despite the whopping drop that Meta has had, 31% in a matter of 2 months. This is getting ridiculous. Let's talk about Microsoft. Microsoft, I'm going to nickname it the black hole that sucks. All B2B software competition. All B2B software competition can be put out of business overnight with a software update. And sure enough, Teams, when Teams was released, everybody was making fun of Teams. Now, I don't really follow Slack anymore, but I can tell you Slack is probably not as big of a thing as it used to be. Same for Zoom. Zoom is probably not as big of a thing as it used to be, just because Microsoft can just do a software update, force the product to more than 100 million business. Actually, I think it's 130 million businesses run on Microsoft. Enterprises run on Microsoft. Governments, cities, they all run off Microsoft. It's the most dominant B2B supplier in the world. I mean, it still has the PC business as well, where they are dominant, but they don't make much money on that one. This is the first fastest growing company in my sheet at 14% next 12-month revenue growth. It's also the third best rule of 40. So I wouldn't like Microsoft as much as, say, a Meta, for example. Microsoft is actually the one that I like the least along with Apple. Apple and Microsoft are the two stocks I like the least on that list. Anyways, they have a major OpenAI investment. So, the jury is still out. Like we don't really know who's going to be the big winner, right, in AI. Is it going to be Meta AI? Is it going to be X and Grok? Well, if it's X and Grok, as public investor, it's too bad because we can't own it. Is it going to be Nvidia? Yeah, right. Our AI models, are they just going to compete and we're going to switch from month to month from an AI to another AI to another AI to another AI, and then the winner from this competition is Nvidia selling GPUs to power this revolution? But anyways, it's a hedge. Like whether someone thinks it's good or bad, it's a hedge, because if ChatGPT wins, then you have exposure to that via Microsoft, right? And if Gemini wins, you have exposure to that via Google. If Llama wins, you have exposure to that via Meta, right? Kind of wish Tesla would get involved with Grok and get some ownership in X so that you can have exposure to Grok. What is Apple doing? What is Amazon doing? We don't know. They're sleeping. They're not doing much. What do you think? Apple at Siri. This is a major, opportunistic loss for Apple that they did nothing with Siri. Anyways, the last thing I'll say about Microsoft is of course Microsoft Azure is a big success. Obviously, if Microsoft offers a cloud product, why would you go to Amazon or GCP? You use Microsoft. You stick with Microsoft for everything you do, and that's what a lot of businesses do. And of course, Microsoft is actually, this is gonna sound crazy, but it's only down 20%. So it's not as much of a deal as the other ones. It's only down 20%. The returns, though, for Microsoft has been as outstanding at 24%. All of these stocks, on average, have returned 25% a year, except for Nvidia and Tesla, which are my growth investments in this, Nvidia and Tesla. Let me conclude with Tesla. So my top buckets in investing, I have a bunch of growth stocks, high growth stocks. That's one bucket. My other bucket, and that's the biggest bucket, that's Bitcoin related stuff and MicroStrategy. And then I have a major stake in Tesla. Tesla is, well, it's now my second biggest position as far as stocks go, or third biggest, because Bitcoin and MicroStrategy is ahead of Tesla in my portfolio. But Tesla is a huge position for me. It's right in front of HIMS. It's a huge position for me, but it's a controversial position. And the controversy around this stock I've been following for years. The controversy moves from season to season. There's season this stock is trendy. There's season this stock is controversial. It's controversial because it's non-consensus, right? Some people hate Tesla. Some people love Tesla, and there seems to be no middle ground, just like there is on all of the other ones almost. You can find middle ground on all the other ones, but not Tesla. Tesla is the most hated asset, but to others, it's the most loved asset. Anyways, let's look at Tesla. The numbers, price to sales for Tesla is actually not that bad. The price to sales is a 6 for the opportunity they have. In my view, price to sales is not that bad. However, because of the growth is so mediocre going forward, because a lot of their initiatives are 2028 and beyond, because that growth is disappointing going forward. Don't forget they have a product that is financed and interest rates are very high, so it's tough to sell cars because cars are financed. Anyways, the point is that 12% revenue growth for the future is not making it look good in my enterprise value over gross profit over revenue growth metric. It's the 3.46. It's about like Apple, trading as expensively as Apple. A lot of the valuation of Tesla boils down to, are they solving FSD this year? If they are solving FSD this year, then the robotaxi thesis unfolds, right? And that's still what I believe, right? And of course, people dismiss Elon and say, oh, he's promised it so many times and it's not happening. It's never going to happen. There's longer-term catalysts. One long-term catalyst that, of course, everybody seems to forget or hate is that he is connected. At this point, we've seen enough video to say that he is friends with the president of the United States, right? Friends with the most powerful man in the world. And so you got to wonder, what about that policy of trying to deduct interest rate payments on made in USA cars? That's a tailor-made policy for Musk. How many more policies are going to be tailor-made for Musk in the United States? Probably quite a bit, because I've seen enough video, enough news to tell you that Musk and Trump seem to be real buddies. And so when you talk to the most powerful person, they're going to put policy in your favor. You may remember that was the same story for GM. The last president, GM, Mary Barra, CEO, and the last president, they were real buddies. And so GM got something like $4 billion for like factory investments or whatever, and they got a bunch of goodies in the IRA. So political connections can really help a company. Arguably, though, and this is again an argument, but arguably this is led by our era's Edison. Arguably, Elon Musk is our era's Edison, and what's funny is that he's our era's Edison, in my view, down to the controversy. You would not remember, but you may have read in biographies the story of Edison and the electric chair, and you know that was probably a very unethical thing to do, that electric chair. But anyways, there was controversy for Edison in that era. Controversy in this era for Musk. I don't really know what. I don't follow people news. I don't really know why people hate him, but people hate him. So anyways, if EVs will be a thing, Tesla will dominate And that's just the way I look at it. And latest Chinese data, in my view, does not confirm the BYD threat. I know the anti-Tesla crowd are very big on BYD, but BYD sells tons of hybrids. And if you look at the latest data in China of how successful the new models of Tesla are, I do not get the BYD threat. Even in Europe, I do not see it. I saw a few BYDs in France. They're ugly, quite frankly. I mean, this is all subjective, but they're ugly, right? Might as well buy a European-made car. Anyways, that's just what I think. Opinion differ, of course, depending on who you are, and that's perfectly fine. Not being in agreement is what gives you alpha, and that's why, the fact that everybody agrees on Nvidia and Nvidia is so low, I cannot understand. I really cannot understand. Anyways, Tesla's, of course, being a hated asset stand to outperform. Tesla 40% average annual return in the past 15 years. And look at that. Tesla is down 50% since December. Volatility is the price to be paid for higher return, because this stock, Tesla, is the stock that is down the most since the start of the year. It is also the stock that has performed the best. Keep in mind, I'm taking 15 years, but if I had taken the past 5 years, which is really when the stock has seen the most volatility, it's performed one of the best. More volatility equals performing better, and that's something that I've witnessed so many times in assets. So volatility is a good thing. Volatility is the price you pay for a higher return. Anyways, this was not investment advice, not financial advice. This is just entertainment. I'm hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful day.